Hi everyone, welcome to this month's financial markets update. Well, August was a pretty busy period for financial markets, and there were probably 3 or 4 key takeaways from our perspective that impacted the performance of markets over the month, but will continue to drive market performance through the latter stages of this year into next year. The first of those, we were in the midst of the domestic reporting season. And by and large, we felt that it was actually a pretty solid period for domestic corporates here in Australia, and the results were quite solid. I think a number of the challenges that we saw, though, when we were looking at sort of the outlook statements really hinged around the impact that the Delta variant was having on the speed and the ability of the economy to reopen, both domestic as well as global, particularly for those companies that operate in global markets. And the second aspect associated with just the impact that supply chain logistics was having on both raw materials, finished goods, and the overall cost pressures that were coming through profitability lines as well. So from that perspective, we felt there were a couple of key issues. But as I said, by and large, we were pretty comfortable with what we saw. Good, strong earnings growth from many corporates across our portfolios, and that reflected in the broader market up over sort of 2.5% over the course of the month. The second key aspect that we saw through August was really the ongoing commentary coming out of China relating to its regulatory pivot. The most notable comment that I think that we saw was the term common prosperity really coming to the vernacular more and more, and the challenges that we feel present for many of the large corporates in China, Tencent, Alibaba, etc., as well as obviously very wealthy entrepreneurs. There's definitely a push, in our view, as I said, to reduce that wealth factor being concentrated, and that clearly has implications for financial markets, both in China as well as emerging markets more broadly. Now, emerging markets had a very solid rally, up over 3%. So it does highlight that when you talk about emerging markets, it's not just China, but clearly they have a big impact in regards to Asian equities, and equally right around the world, given they are now the second largest global economy. The third aspect that we saw over the course of the month was commentary regarding the beginning of tapering of quantitative easing programs, QE programs, that we've seen become very prevalent over the last couple of years, and certainly really post the GFC. US Federal Reserve announced they would be beginning their tapering program through the back end of this year, and in our view that is appropriate, and I think it affords them greater levels of flexibility regarding when they may start to look to increase official cash rates. And I think that there's a clear nexus between tapering programs, reducing their bond purchase programs and the like, providing support and other means to financial markets relative to where they see their official cash rates. And I think that inflationary pressures are continuing to build. As we spoke about previously, we think inflation will be higher through the cycle than potentially what's priced into markets at this point in time. It's one of the key reasons why we think bond markets are very expensive relative to other parts of financial markets at this stage. And just to sort of highlight this in the context of supply chains, you can see here on this chart, we've got a chart just showing the semiconductor index, Philadelphia Semiconductor Index, versus US consumption and inflation. And you can see that personal inflation index and semiconductors basically rides higher in tandem. And the cost pressures that we're starting to see, as I said, when you think about semiconductors and their use across multiple industries, auto, IT, healthcare, etc., you can see that is having pressure now coming through in terms of higher inflation throughout the system. And in our view, therefore, central banks will start to need to think about that, particularly given that the growth outlook remains reasonable, albeit, as I said, under some challenge, just given the impact of the Delta variant. So clearly a number of factors in play. We think that will lead to higher bond yields that we've spoken throughout the course of second half of this year into 2022. And that has implications for a whole host of asset classes, the more interest rate sensitive, as well as the growth asset classes more broadly. If bond yields move up in more moderate fashion, which is, I think, the design that central banks are trying to achieve, we don't think that will derail the growth outlook. If they're more violent in terms of what we saw through February, clearly that has implications for equities. And equally, if inflationary pressures remain elevated and higher than what central banks are anticipating, again, that may have implications for equities as well as bonds throughout the cycle. So a really interesting month in terms of data, an interesting month in terms of the policy framework. And as I said, I think that's going to continue to drive markets through the second half of this year into 2022. As always, if you have any concerns or queries about the portfolios, please feel free to reach out to anyone in the team. Thanks and bye for now.